Guess what's the second most important part of Maryland's economy? It's finance, insurance, and real estate. In fact, that makes up just over 22% of Maryland's total economy. So no wonder they tax the living daylights out of a real estate transaction. In fact, if you're planning to sell a home this year, you should know all about capital gains tax. In this video, we're going to go over 4 ways on how you can avoid it. Let's start with what exactly is a capital gain. A capital gain is the net profit earned when you sell a capital asset. So what's a capital asset? Well, a capital asset can be things like land, a business, your home, or stocks and bonds. The federal government taxes these gains less than income tax. However, in Maryland, there's an additional tax, which is 5.8%. Now, you may be thinking 5.8% is under 6. That's not really that bad. Maybe I'll just pay it. Well, once you take into consideration all the other taxes that you're paying in Maryland when you have a real estate transaction, like recordation taxes, transfer taxes, local taxes, this can add up. And then when you add in the federal tax on top of that, you're looking at about 30% in capital gains tax. Now I bet I've got your attention. Let's talk about 4 ways that you can avoid paying that. By the way, my name is Kelly Wise. I am a licensed real estate agent here in the state of Maryland. So how can you avoid paying capital gains? Well, the first way is to make the property your personal property. If you have lived in the property 2 years out of the last 5, it can be considered a primary residence. When selling a primary residence, the first $250,000 if filing single or $500,000 if filing married jointly are exempt. This exemption is only allowed every 2 years. You may be thinking, just how does this exemption work for me? Well, here's an example. Let's say you have a rental property that you purchased for $150,000 10 years ago. Today, it's worth $300,000. That's a capital gain of $150,000. Ignoring depreciation recapture, this would mean you would potentially pay a federal cap gain of 15% or $22,500. However, as a primary residence, this capital gain is under $250,000, so it would be exempt. The second way that you can avoid capital gains is to buy the property with a self-directed IRA. You may be thinking, I thought IRAs were for retirements. Well, they are, and this is very similar to having an IRA with investments like in the stocks and bonds, except this way it would be in real estate property. The first step in doing this is to get yourself a self-directed IRA with a custodian. And it's good to note that you and your family are not allowed to live in the property. This is solely for investment properties. In fact, the IRA actually owns the property, not you, because you and the IRA are separate entities. Using this method requires paying in all cash, and then all the expenses are paid out by the IRA. Using this solution can be a little bit tricky, but it does provide a great return on your investment. I'll put a link down in the description box below so that you can read more about using this solution. Number 3 is to do a 1031 or a like-kind exchange. Section 1031 of the IRS tax code allows investors to sell a real estate property and then go out and buy a real estate property of equal or greater value while deferring the tax on the capital gain. This requires a bit of planning because there are time limitations and rules that you must follow in order to make it work. However, you can use this method to defer taxes for the rest of your life. Just because the tax code says it must be a like-kind property doesn't mean you have to sell, for example, a single-family home and then go buy a single-family home. You can actually sell, say, a commercial property and then go buy 6 single-family homes. Our last method, method number 4, is to do tax harvesting. If you're familiar with stocks in the stock market, you may already be familiar with this strategy. Tax harvesting is basically selling an investment property with negative equity to offset the gains that you made from selling another property during the same year. Charles Schwab actually has an article that they published with a lot of examples and a more detailed explanation of how you can make tax harvesting work for you. I'll put it down in the description box so that you can look at it later. So there you have it, 4 ways to avoid capital gains tax when selling real estate property. If you haven't done so already, please click the subscribe button and the bell. Thanks for watching. My name again is Kelly Wise. I am a licensed real estate agent in the state of Maryland. See you guys next week.